Hey y'all, and good now, whenever and wherever this finds you. Well, surprise, 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 it's happening again. There's a bubble being created intentionally by misinformation, and I've edited down a video about the stranded assets that we're facing coming up in this next decade. So here we go.
For the past 10 years, a financial bubble in conventional energy assets has been gathering steam. Just like the credit rating agencies ignored actual market data in the buildup to the subprime mortgage crisis in 2008, mainstream energy analysts have ignored actual market data and have enabled the mispricing and overvaluation of conventional energy assets. Yet, despite this clear evidence of disruption and collapse, the U.S. Energy Information Administration has predicted a recovery for coal every single year for the past 10 years. Today, solar and wind are the cheapest sources of energy, period. Not just that, the total cost of nearly firm power, that is, solar plus 4 hours of storage, is cheaper than the operating cost of conventional generation. Even if the conventional power plant itself were free, the fuel, operating, and maintenance costs are higher than the total costs of solar, wind, and battery. In our new report, we show that much of the mispricing and overvaluation of conventional power plants can be traced to a fundamental error in the calculation of levelized cost of electricity, or LCOE, a key metric that policymakers, regulators, utilities, and investors use to compare energy technologies. Virtually all widely cited sources of LCOE analysis assume that newly built coal, gas, nuclear, and hydro will be able to successfully sell the same amount of electricity year after year from now through 2040 and beyond. Market data show that this assumption is totally false. And here we come to the crucial issue. Mainstream LCOE analyses assume that capacity factor, and thus electricity generation and sales, will start at an unrealistically high rate and then remain constant year after year after year for a power plant's entire 20, 30, 40-year long lifetime.
But these are fundamental errors. First, capacity factor will not start at a higher rate than market reality.
Power plant capacity factor will at best match the market in its first year. And then it will decline as conventional power plants are outcompeted and disrupted by newer technologies. Because they overestimate capacity factor and therefore how many units of electricity these power plants will be able to sell in the future, all of these widely cited sources dramatically underestimate the LCOE of new coal, gas, nuclear, and hydroelectric power plants. Meanwhile, the EIA's LCOE calculations have always assumed that any newly built coal power plant will enjoy an unrealistically high capacity factor of 85% every single year from year 1 through 2040 and beyond. Yet, the EIA's own historical data clearly show that at no time in the last decade has coal's capacity factor been anywhere near 85%. They're not using their own capacity factor data in their LCOE calculations. And 85% is not remotely plausible looking into the decade of disruption ahead. So what does reality look like? When we recalculate LCOE using actual market data and change nothing but capacity factor, we find that the value of coal looks completely different than what virtually all mainstream analysts would have you believe. By 2015, actual coal LCOE was already substantially higher than reported, with a corrected LCOE that was 50% higher than what the EIA published in that year. By 2020, the corrected LCOE, based on actual market data, was more than 3 times higher than the figure reported by the EIA. And looking ahead, as capacity factor continues to free fall, we find that the LCOE of coal rises accordingly, so that by 2030, the corrected LCOE is 9 times higher than the EIA's current estimate. 9 times. By 2020, corrected gas LCOE was 60% more expensive, nuclear 175% more expensive, and hydro was 3 times more expensive than mainstream analysts published figures. By overstating capacity factor at the plant level, mainstream analysts are enabling investments throughout the conventional energy value chain that would otherwise not be made when using realistic market-based data. The organizations that have miscalculated the LCOE of coal, gas, nuclear, and hydroelectric power plants are playing a critical role in enabling the mispricing of and overinvestment in conventional energy assets that is analogous to the role that the credit rating agencies played in enabling the mispricing of subprime mortgage assets, which, as we know, led to the housing bubble and the global financial crisis that followed in 2007. We recommend that policymakers, regulators, energy investors, civic leaders, ratepayer, and taxpayer advocates demand that analysts calculate LCOE on the basis of actual market-based assumptions for capacity factor and dynamic realistic projections for all variables of their LCOE calculations that include the reality of the disruption ahead. Government regulators, including public utility commissions that ostensibly approve power plant investments on behalf of the people, should not enlist ratepayers or taxpayers to subsidize, insure, or provide a backstop for any new or existing investments in conventional energy assets, including power plants and their value chains. Demand that regulated utilities that push for new conventional power plants use their own shareholder equity capital. If a project is not good enough for shareholders, it is certainly not good enough for captive ratepayers or taxpayers. Protect ratepayers and taxpayers against regulated utilities who are trying to offload risk through ratepayer-backed debt or securitization. We have seen this movie before. Assume that every conventional power plant will be a peaker without the ability to charge peaking prices.
The disruption of energy by solar, wind, and batteries is inevitable. The longer we wait, the more difficult it will be to diffuse the great stranding of the 2020s and avoid the worst impacts of this financial bubble.
We need to protect people, not incumbent companies or industries. The time to act is now.
Well, luckily for us, it is happening now. And the future is really bright. And it turns out that we're just being hoodooed again, like we were with the financial crisis. And I imagine it's about the energy companies, oil, gas, and coal, wanting to hold on to their captive audience of people that have to have their product. This was very informative for me, and I hope it was for you, and I hope you enjoyed it, and I will see you down the road.